Hey guys, welcome back to the Capital Mindset Show. Today we're going to be doing a reaction video that was requested in the deluxe Discord server down in the description below you if you wanted to join. It's actually free to join the regular Discord server, and we actually do polling data or voting on what videos I'm going to do because, again, the content is driven by you guys, the subscribers. So that being said, we're doing a reaction video on CNBC, how the rich avoid paying taxes. So again, this was requested. I had another CNBC reaction video that turned out to be very cringeworthy, and I think I'll leave that in the description below. Now, to be honest, we're looking at this from the academic standpoint, not from the political standpoint, because I think some people might get a little bit confused as to what is the purpose of this, right? There are some political points of view and then some objective realities as to how like the tax code actually works. And then there's some vernacular that, for example, in the last video, they just simply got wrong. So you actually don't realize how bad journalist majors are at kind of reporting on a specific industry until you have kind of a professional experience within that industry, whether you're an engineer, whatever it is you are. And then so it kind of makes sense that someone who studied something completely unrelated doesn't really have their statements correct. So journalists are meant to, draw and ask questions, not to really draw conclusions. And I don't really pay attention to any journalist who tells me their conclusions about anything. But on that note, enough ranting about that. Let's go to the actual reaction and we'll hear it. I haven't actually seen this video. I only saw the very beginning. I was like, no, I'll do it live and react live. So
the more money you make, the more you have to pay in taxes, right? Well, not always.
Here in the US, the more you earn, the bigger a percentage cut the government withholds from your pay. But here's the thing. The ultra-wealthy typically take advantage of rules in the tax code, which enable them to lower their effective tax rate.
The rich are different from you and me, as the old saying goes, in large part because the sources of their income are different.
Just take the case of billionaire Warren Buffett. He often points out that he pays less taxes on a percentage basis than his other employees, including his secretary. The reason? Well, most of his wealth comes from his stock holdings, not his annual salary.
The great thing about stocks is that you aren't taxed till you sell them, and even then, the taxes are typically lower than the rates on wage income.
So if you ask people, what bothers you most about the tax code, complexity is a common answer, but also the feeling that the wealthy don't pay their fair share, or the feeling that corporations don't pay their fair share.
In 2018, Amazon famously pulled in over $232 billion in global revenue, and yet its federal tax bill was $0. And in fiscal year...
Wait, they just said revenue. They just said like revenue. So you pulled in revenue, and so you're taxed on revenue. All right, so real quick pause here. So Warren Buffett, yeah, he said that, but he also said that his secretary is also pretty wealthy because she owns a lot of stock in Berkshire Hathaway. And that's, yes, what they're stating is absolutely true. So the tax rates on wages are actually substantially higher. And that's actually because that's how the government has actually structured it to be so. Because wages are a realized event in which, the government has dictated. So the government basically has in the tax code what we call taxable events. Okay, so taxable events is when you do a specific action, monetarily speaking, you will get taxed. So if I receive money, if I receive dollars for something, for my labor, I will get taxed. If I hold something and someone bids it higher, you don't get taxed. So like imagine this. Imagine you have a rock and I say to you, that rock is worth $10, okay? So then, we say today it's worth $10. Let's say 10 years from now, I come to you again and I say that rock is worth $10 million. Okay, so that is a valuation that I have proposed to you, and that's my bidding offer. So that's basically like the stock market. The stock market is a bidding process. You own a share in a company, and every moment of every day, it's being bid, right? So you are taxed. And then when you go to sell that rock, in this instance, going back to the example, that is the taxable event, and then the government comes in and takes their cut, so to speak. Now, why do you think, let's get into like the crux of the issue, why do you think that tax rates for asset holding is let's say, lower, right, for the long-term gains? Because what they didn't mention is that if you were to sell in the short term, you're actually taxed at disadvantageous rates, same to wages. So they didn't actually mention that, but just so we're clear, unless they might mention it later, I just want to clarify that for you guys now. If that were to be the case, or if they don't mention it, you have that information there. Okay, so if I want to encourage long-term investing, and this is actually the thought process, it's so that, you think the government's not entirely idiotic, and this is very similar policy across the globe. You want to encourage long-term investment so you kind of reduce the volatility and actually allow the system to mature, so to speak. So in that sense, we don't want to encourage short-term gains, so we encourage long-term gains. We encourage that behavior. And that's a lot what the tax code really is implied for. I've already discussed in the last video that tax rate doesn't actually matter when you actually measure tax receipts over long periods of time. The greatest correlation the data shows is in fact GDP growth, and anything that is done to harm GDP growth is in fact going to be a greater deterrent of overall tax receipts at the end of the day, if that is what your goal is. If your goal in this instance, if the proposal is to increase and generate more and more and more tax revenue, then the actual solution is to grow the economy, go figure, but not necessarily to increase rates per se, unless your goal is something else, right? But my counter proposal to that is it really doesn't matter what is said here or what policymakers say. The market is really, really dynamic and interesting, and it doesn't really care what it is that we believe, and there'll always be places to kind of adapt. And this is speaking as a Venezuelan whose country is quite literally in the poop bucket right now. Well, there's a lot of nuances there as to what's going on now, but we'll leave it with that.
2020, at least 55 of the largest corporations in America, including FedEx and Nike, also
those same exact companies that we've kind of already debunked in the last video, but that's journalist majors.
Managed to pay no federal corporate income taxes.
Yeah.
There's a great Supreme Court case with Judge Hand going many years ago that it's not the taxpayer's responsibility to pay the most taxes that he can. It's the taxpayer's responsibility to pay the least taxes that he can. There's even a rule within the IRS code that if you want to pay more taxes, you can write a check to the United States Treasury and you can take a tax deduction for that.
But some experts say tax breaks are designed to reward the taxpayers who are helping to pump up the economy.
Individuals who are not, again, contributors in terms of real estate and businesses, they don't get tax benefits, but it's because they are not contributing to, the economic growth at a larger scale.
So how exactly are they?
Whoa. Why you stop her? Let her talk more. But no, she's right. So usually they had guests on last time that didn't even use the right vernacular. So far, this woman right here, CPA and founder of Fulla Financial, no, she's absolutely right. And if anyone out there is a CPA, a lot of my audience is a CPA, you remember from your tax classes that it is actually your responsibility to help your client in the best way possible to actually lower their tax bill at the end of the day. And the IRS tax code is built in such a way that it is trying to, like we said earlier, encourage certain behaviors so that to grow the overall economy more and more and more. That's the goal. That's the intended goal. And so because that's actually how the government will actually rake in greater tax receipts, okay? And tax receipts is tax income. Usually when a politician, this is why I say avoid the political, put your politics at the door. This is kind of just entering the realm of tax academia, so to speak. And I'm not a tax lawyer, so I'm not actually speaking on the actual tax code per se or specific parts of it, just kind of on a higher level, on a bird's eye view of the tax code.
Biggest earners using the tax code to avoid paying taxes. To understand how the wealthy take advantage of the tax code, you first have to look at where all that wealth comes from.
The biggest loopholes arise when you have...
Okay, that's a criticism. The word loophole, and I think my way back when was my tax professor, who she taught on the master's level, and she was a tax lawyer. She actually got rid of this from her mind, and that's actually something that even CPAs, they use, but like tax lawyers don't like the word tax loophole because it implies illegality, but it's not. So it's part of the actual rules. So it's just following the rules. It's not a loophole in the rules, but whatever. Because there's tax avoidance and tax evasion. Evasion is illegal. Avoidance is completely legal and built into the system, and it's encouraged to do so. Okay, again, like they already established it, so now I have to almost take back my word saying it because she's already starting off with that word.
Have assets. Most Americans don't have assets. All they are depending upon is their income from their salary from their employer. So if you have someone who has assets such as business and real estate, again, they are unlocking different areas of the tax code that most individuals do not get to explore.
You can think of someone's wealth.
Okay, I got to take back my then criticism because then she kind of said it beautifully. Okay, so I take back. No, I don't take it back, but it doesn't take away from that point. All right, so my tiny criticism on the vernacular doesn't take it away, and it's a very common use of the word, so I'm not even going to say that, technically that's like completely out of place. So no, she used the word loophole, whatever. But no, what she said was exactly true as an individual investor. And I've been actually getting requests to kind of make videos in kind of targeting newer investors. And I'm going to try to make a new investor video series as well. But yeah, if you're newer to the markets, if you're very young, this is a kind of a lesson moment for you. You want to own assets globally, everywhere, in every country on earth. You want to do this. Even if, well, I mean, even in like, let's say a communist country or socialist country like Cuba and Venezuela, you want to be then in the government. If I was like being legitimately, I would say you kiss butt in the government, you join the government, you get a lot of power, and then you use that power to then own the assets. So that's like the game plan in those countries if you want to be successful. And if you want to be successful in more capitalist countries where it's kind of like you don't have to do that, you can just do it on your own work merit, then you have to then build yourself up to eventually own these assets, which in United States, this system is fairly easy to actually start and begin owning assets, which is the wonderful part of it. You just literally open up an app, you have your income coming in, you start to purchase assets, and then you can eventually scale that up. You can buy real assets, you can buy whatever kind of assets you really want. There's not really a restriction. There are some, but most of the part, no.
Wealth is being comprised.
The audio here is terrible, by the
separate
way, for some
assets
reason.
which fit into one of 3 different tax
This is
buckets:
CNBC. Where's your audio?
taxable, tax deferred, and tax free.
If your only form of income is your annual salary, then all of your wealth just fits into the taxable bucket. But the rich also tend to diversify into other types of assets and investments that the tax code doesn't consider to be taxable income. There are individual retirement accounts, some of which are not subject to federal taxes, and then you have investments like stocks that fit into the tax-deferred bucket. If the value of your stock portfolio goes up, you don't owe tax on those gains until you realize that gain, aka not until you sell that stock. And even when you do sell, the tax rate is typically lower than the rates on wage income.
Capital gains can be avoided in life and also largely avoided in death. And so that's highly advantageous to high income, high wealth people.
Capital gains taxes also apply to bonds plus tangible assets. So think things like real estate.
They're referring to the death part because when you die and you pass over stock, the cost basis actually changes. So, I'm already kind of like getting the idea or the impression that professor is kind of like a little bit out there. But so far what they're saying is not necessarily true. I understand that they're kind of putting it into some sort of narrative, but they're also making it sound like it's only the ability of the wealthy to really do this. It's like, no, it's not exclusive. Like, it's not like a class thing. So like anyone who wants to purchase stock benefits from the exact same thing. If you don't sell, you don't get taxed. In fact, you actually have, people don't know this, there's actually a threshold you have to pass, for example, in dividend income before you even get taxed. And by the way, I'm only speaking to Americans here. I'm not speaking to anyone outside of the United States. So that only pertains to the United States and at the present tax code. So, but you have to talk to your tax professional, those details, because obviously, I'm not your tax professional. I'm not going to be doing your taxes either. I don't even offer those services. So that's something to think about. I know Australia has like the most Chad dividend policy ever. So, go live in Australia. But yeah.
Or cars and boats. And with the right tax planning, you can time it such that you only realize those gains during a fiscal year when you have big capital losses to offset that gain. You can also skip the tax entirely if you pass that appreciated portfolio onto your heir when you die.
That's not necessarily getting free money because you did technically realize losses. That's what the part that doesn't make sense to me when they always phrase it that way. It doesn't make sense on its face. You're just selling some assets and you're selling other assets for a loss, and they're kind of counterbalancing each other. Of course you have to do that, because you lost your value. The tax code is implied that it only taxes when there's value gained. When there's real value gained and you can experience that value gained, you get taxed, okay? Because when you sell at a loss and then you sell at a gain, those net each other out. they make it always sound like you're just like printing money. It's like, no, you're not. This doesn't make any sense. Of course, let's say hypothetically you did sell at a loss and then it continued to go down and you bought back in and then you were able to tax or get that gain, or sorry, that loss, counterbalancing that gain. And then with that repurchase shares, then it recovers, okay, fine, but that's just good moving. That's not necessarily just printing money right then and there. That's circumstantial. You can't predict what the market's going to do like the next month or so, because there is a time limit. You can't, it would be classified as a wash sale essentially. So you can't just do that and like the next day. You got to actually have a time frame, and that's a risk that the investor is taking when they do that, and that's the risk that you pay. Okay.
Plus, owning property opens up higher earners to even more ways to chop down their tax bill.
If you own real estate, you can now deduct things as depreciation, real estate taxes, property taxes. Even if you are not investing in real estate to get rental income, even if it's your primary residence, you can itemize your tax deductions on a Schedule A, which can also lowerly affect your tax liability. On the other hand, if you do have rental properties, you can take advantage of depreciation, your expenses related to your real estate property, and earn some extra income while paying minimal tax on that additional income that you are earning.
And these strategies are just the tip of the iceberg. There's a whole patchwork of ways to drive down that annual tax bill.
There's not some magic deduction or magic credit that people overlook, and once I tell you, you're going to get a $10,000 refund. What there is a myriad of rules, opportunities, and options to lower your taxes. I'll give you a simple example. There's almost 12 different tax breaks for higher education, whether it be the tuition and fees deduction, 529 plans where you can put money in an account and have it grow tax-free.
Borrowing against the value of real estate, or borrowing against the value of insurance policies. For example, you can take out a life insurance policy with a high cash dividend and then borrow against that from a bank. The bank sees that as an actual asset, may loan up to 90% of the value of that life insurance policy. That loan is effectively income to you, but in the tax code, it's not considered income or a capital gain. So it's tax-free.
No, it's not. It is not tax-free. You will pay at the end when you end up selling it to repay that asset. You can't just, okay, so, because I know this argument's used a lot, but no, you're making it sound like it's like risk-free, it's free money. It's not free money, it's a loan. Imagine if you start getting taxed on loans. That will be crazy. Because that changes the dynamic of everything. At that point, you wouldn't borrow in the United States. And then who would really benefit from that is then that's really the ultra-rich who benefit. Because let's say some guy who's working a McDonald's job and or a fast food job, anything like that, they're just starting out. So a younger guy or maybe even an older guy, but it's just someone who's starting out in that position. They want to purchase a home, right? And, maybe they're in a cheaper area. Let's pretend they're in a cheaper area, because then we can get into the whole discussion of why real estate prices are where they're at, but we won't get into it. So if they want to purchase a home and they want to then borrow against that, imagine that the government comes in and puts like a tax burden on that borrowing now. Okay, well, it changes the whole dynamic. Remember that on the top of that the higher income earners are essentially they are high quality assets for the bank, and lower income is lower quality assets for the bank because they have higher risk. Okay, so when you lend out to lower quality assets, right, if we're thinking from the bank's perspective, then you want to offset that with higher quality assets as well. So if you, for example, start to tax cash that is borrowed in the banking system, you then encourage just simply other forms of borrowing elsewhere in the world. And you could try it out, but I can guarantee you, for example, like let's say I get taxed, like let's say 5% borrowing tax if I want to borrow and do something with that money. Well, then I'll just go out and borrow in a different country. I have more readily available access to do something like that, or someone else, or like Bill Gates, to Elon Musk. Everyone in the world would probably want to lend to Elon Musk. Whether or not that's good or a bad idea, I can just tell you that the banks around the world want to do that. And so will the government of the United States start taxing British loans? Will they start taxing French loans? How will the French like that? How will the British like that? Will you start taxing Japanese loans? You see, it starts to convolute the thing. So it's not really a practical policy or thing to complain about. And when you break it down, it's not that it's free money. It's in fact, it is risky. You are borrowing at the end of the day. You have a collateralized asset. It's very different, but whatever.
So there's these kinds of techniques that can be used if you have a lot of income and a lot of assets that are just not available to ordinary people that don't have that kind of.
Well, you can build up to it though. For example, Bank of America's policy, I think it's after a couple $100,000, so someone can build up to that, and then you could of course borrow against that. And actually M1 Finance lets you borrow against it pretty much readily available, so that's actually not even true what she's saying. She just doesn't do enough research. But it's funny, as a professor, no research being done, but no, you can actually do that. Of course, you will find out quickly just how risky that is. Okay, so I recommend everyone look into it. I don't recommend anyone do it, but you can look into it. You can find these brokerage platforms that will let you borrow against your assets, okay? It is a thing. You can do it, okay? Also, if you own a home, you can borrow against your asset, right? You can refinance. You can borrow against your asset. A lot of people do own homes, in fact. But again, let's say anyone can start up a brokerage account, and then let's say you save up to a 10,000, and then you later save up to 100,000. But I think even up to 10,000, I believe there is a limitation, but it's not as high as something like Bank of America's. And this is readily available for anyone. Everyone can do it, and you won't get taxed on it because there's a risk to it, and you'll find out. Just better to do it yourself and then figure out the mechanics of it than kind of be like this lady who's probably never done it. And she clearly, I can tell you that right now, does not understand or comprehend that there's risk involved. She kind of thinks of it as this free money that's just, just borrowed money. Like, let's think of it like that. We'd see that Meet Kevin, or not Meet Kevin, other people, I don't know who, real estate guys, they borrow against their real estate and they go out and buy more real estate. So they're increasing their leverage, okay? So for those, this is a stock channel. Most of you guys do understand stocks. Okay, what happens when we increase the leverage, everyone? Well, we increase the R word, risk. We increase the risk. They don't have some sort of like special privilege that they don't have to pay it back, right? Imagine that Elon Musk borrows money from Goldman Sachs. It's like, yeah, I'm not going to pay you back. The risk is he loses his Tesla shares. He gets collateralized, that he's collateralized onto the loan, okay? So kind of remember that risk is a cost. There is a cost, right? And so it's not free money, all right? And again, we already went over why it wouldn't be taxed.
Disposable income.
In 2013, many-time Grammy winner Lauryn Hill was sentenced to 3 months in prison, 3 months of home confinement, plus a $60,000
Okay, way convoluting, but this is tax evasion, not avoidance.
fine for not reporting more than $2.3 million in income. She isn't alone. Some of the biggest names at
Tax evasion, not avoidance. They're kind of merging the two. So you can't just do that. You can't just say, I'm not going to pay the tax. Right? That's illegal. But avoidance of taxation is not illegal. So I don't like when they do this. They did this in the last video too. They kind of merged the two vocabulary terms together. And normal people, I guess this is who watches CNBC, normal people. You see 800,000 people watch this, and I don't know how many people disliked it. But anyone, I'm not going to dislike it or like it, but I don't really care. And I don't even want to go through the comments because, this is the problem with, this is why if you want to invest based off the information these guys give you, you're going to lose money, right? Because think about the quality. This is the quality on this. Imagine the quality on everything else, right? So ask yourself, would you put your money behind their words, their statements? And if the answer is no, why would you listen to anything else they say? But regardless, I'm kind of on a tirade there. Avoidance, evasion, please separate the two. They're very different. They're kind of just talking as the transition. There was no transition. There was no explanation. Oh yeah, what we were just talking about was avoidance. Now this is evasion. No, they didn't do that because they're not trying to be genuine.
In Hollywood have had serious run-ins with the IRS for failing to pay their fair share of taxes.
To be clear, these are all examples of tax evasion, which...
Oh, thank God. Okay, I take entirely what I said back. It would have been better for you guys to put this beforehand. See, I did this video raw. I haven't seen this video yet. Okay, CNBC, you won me over on this. Okay, completely take back what I said. Okay, so perfect, beautiful little thing.
Which is illegal, not to be confused with tax avoidance. Which
Okay,
is
no,
legal,
wonderful,
even
wonderful.
If it is deemed unfair by large swaths of the population.
Tax evasion is illegal
okay,
and is actually punishable for up to 5 to 20 years
Thank
in
you.
prison.
Yes.
And the law is pretty black and white. There may be some new grayness on things like cryptocurrency, and other new innovations in the world. but most of the time you know it when you owe it. And I can certainly tell whether you owe taxes or not on a situation. But when people come in with fabricated dependents, made up deductions, phantom partnership losses, that's when you get into evasion. And evasion's the line crosser.
Those sophisticated tax strategies that we just talked about, they are all totally legal ways to avoid paying more taxes than you absolutely must.
Tax avoidance, on the other hand, is utilizing the tax code to benefit you in
This
the
would
way
have been better
that
in the
is
beginning
legal.
of the video.
So if there is a deduction for you having a dependent or you being able to expense something through a business, as long as you're following the tax code and the guidelines, you can take these tax positions.
Thanks to lax enforcement.
Should have interviewed basically her and the dude and avoid the professor. Those two know more what they're talking about. I would have put this in the beginning of the video to kind of establish the framework of the vocab, because usually when you give a presentation, and you can see how I was walking throughout the video, I was like, what the heck, you're not explaining that. You're not explaining that. Don't do it in the middle of the video or towards the end actually of the video. Do it in the beginning of the video to kind of establish things, and then kind of allow people to pencil in what is what, not just kind of put it all together and then separate it. Kind of most people might not even get to this point of the video based on how I see how YouTube kind of works.
Enforcement by the IRS, tax avoidance by the top 1% of taxpayers could exceed $5 trillion.
Okay, then this is like a weird stat to just then pull off, and then, okay, I can't say now that you didn't say it, but I don't know how many people are going to kind of digest it. So I would have focused a little bit more on that. But
By 2029, according to former Treasury Secretary Lawrence Summers. This same report found that the top 1% account for about 70% of underreporting. So why is it that the country's top earners also tend to be pros in the arena of tax avoidance?
Well, they hire professionals, and two, that 70% makes sense when you factor in that when you get a wage, the company itself is often withholding the taxes on your behalf, so they're doing that. So obviously the majority of people are on wages, so then they're not going to, have that. So the majority is going to be with the people who are not on wages, who have to self-report, do the work themselves, or hire someone.
Experts tell us a lot of it comes down to tax planning.
Wealthy individuals, tax plan. Most Americans don't have a tax plan. And a tax plan is going to encompass the CPA or tax accountant to go into the new stimulus package or new tax reform and actually look at how they can use the new changes in the code to benefit their clients. These wealthy individuals have that guidance throughout the year to get them to a more reasonable position by year end.
A tax loophole is a provision in the tax code that allows people to reduce their taxes to a point below that intended by the lawmakers.
In other words, it's a technicality that lets the filer avoid a law without directly violating it. Not everyone likes the connotation.
Yeah, loophole's kind of a bad word. I'm not even sure what.
They're saying it. Yeah. I like it. So CNBC, you're winning me back here. Okay, I'm gonna have good things to say about this, more or less. At the end, I'll give like a final rating, but no, wonderful. I love that you're saying this. I, again, would have put this in the beginning to kind of establish the framework for the vocab term, but you're doing it at least. So remember when I was giving that tirade about loopholes? Well, here you go. They're saying it.
Loophole means because it's either legal or it's not legal.
There you go.
And if it's legal, then it's not really a loophole. I would put forth it's a best practice. And what I would tell you, some of the best practice, not of just high-income earners, but any smart, savvy taxpayer, is to take advantage of all the tax rules in the law.
Once embedded in the tax code, it's pretty difficult to get rid of a tax loophole. Each one not only benefits somebody by saving them money on their taxes, but it also typically has an army of lobbyists backing it up.
Sometimes they're not partisan because they are more about protecting a given economic sector or even specific businesses, and that has to do more with the locale. It might be more about what parts of the country, what states, what congressional districts have a certain economic sector that's very important.
Essentially,
yeah, she was completely right there. I mean, I think that's what she's a professor of, so she should stick to that part of the analysis. Because I think that was pretty fair and pretty accurate. Nothing wrong there.
the U.S. tax system creates an incentivized system for those who aspire to achieve wealth. And here's why. You get tax credits for having a business or having real estate. In that act, you are creating opportunities to employ people or creating opportunities to house people. Unemployment and homelessness are two of the major concerns for any government. So why not?
You should just interview this lady the most of the time. I don't really care what I mean, she's doing a really good job. I would have increased her camera quality, given her a better mic, and just let her explain it, because she's doing a great job, CNBC. And I'm saying this because CNBC has such a large platform. So really kudos to them for bringing this woman on. She really, that's, I 100% would agree with. The only thing that I had was at the very beginning, the loophole thing. But then they had the other guy kind of come in and explain that part away. I think he's probably a lawyer or something. Wow, exactly that. So it's all about the incentive, what a government really wants from its economy at the end of the day. So you actually will, when we go out and look in international markets, we actually try to take a look and try to understand. Well, that's not really my job, but there's someone who's dedicated to that. And then we try to kind of figure out, what are the incentives in that country, and is that a pro-business economy? And if it's a pro-business economy, you typically do see a greater quality of life. And believe it or not, for example, countries like Sweden, Denmark are very pro-business, more than you really think. Well, a lot of Americans, because a lot of Americans don't really understand that, but they're very pro-business. Switzerland's very pro-business. A lot of these countries are very, very, very pro-business. And so she's explaining it beautifully. The tax incentives are there as incentives because you want exactly that. You want less homelessness, you want less unemployment. Wow. Okay, great.
Not give tax incentives to those who are going to assist in creating a way to aid these issues. So if you close out tax loopholes and tax incentives, we don't know what the outcome would be, because this can potentially discourage individuals who are contributing to the vast growth of our economy to not make those contributions at a more accelerated rate.
Despite the quagmire
exactly that about acceleration, yes. So yeah, I completely agree with that woman. That woman was fantastic. The dude did a good job at explaining, for example, the nuances of the word loophole. The professor, for the most part, so far, I didn't really agree with much. Not much. I kind of didn't like the way she was phrasing things, but I completely agree with her last point, because I think that's actually what she's an expert on, because she's a political science professor. But yeah, so she understands the nuances of lobbying and all that, but not necessarily the nuances of tax code and tax planning and stuff like that.
Position, the question as to whether or not to close loopholes often pops up in elections and with new administrations.
I have no opinion on this.
Just take the Biden White House. The president is taking aim at some pretty popular loopholes in the tax code, though it remains to be seen whether he'll succeed.
I'll say, I don't have an opinion whether that's right or wrong to do, but yeah, there's just going to be adaptation. It really doesn't matter what you do. At the end of the day, wealthy people will just be wealthy people, and whoever really treats them best in the world gets them, and that's just about it. You have to be the most attractive place to live in, most attractive place to do business in every aspect, production, all that. So it really doesn't matter too much what the United States does or any other country really does. A lot of people like to be like, oh, they're raising taxes, it's going to be a big deal. No, we're not really going to care. But yeah, okay, so final thoughts on the CNBC, much better than the other one. So I thought, this was given to me, but I thought I was going to have, equal level of cringe. You can kind of see how I kind of was cringing in the beginning because of how they were phrasing some things, but then I would have put some of the things in the beginning because it seems like they were trying to almost convolute, but they had very good guests on. So the journalist that was talking, I didn't really care for what she was saying. She didn't really contribute much. She was just espousing her opinion, but I don't think her opinion, was it was okay. The professor's opinions, I think she was kind of outside of her realm. But then when she got into the political lobbying stuff, she was inside her realm because that's what she's an expert on. So she was describing the system pretty accurately as far as I could tell. And the individual, the man and the woman who were, one of them was CPA, I think the other one was a tax lawyer. The tax lawyer explained it really well regarding, and actually I'm going to confirm that he was a tax lawyer. I want to just clarify, he's a chief tax information officer. So he might have a law degree, I have no idea. But, he clearly understands the tax code per se on a deeper level. And then the other woman, she's a CPA. So I think both of them kind of explained it really well. And the fact that they had those two guests on really saved the rest. The guests that they had on the other video, I would say were pretty terrible. So, you know, it actually is that where the journalist majors are almost going to be, they can be more intuitive and they can be neutral, and that's where I think they shine the best when they're neutral. And then the experts they bring are the ones that can kind of provide the real value. So I think in this video that we saw, or that I saw here today, the experts they brought on provided a lot more value. Again, the professor providing the least amount of value, because the only thing that I think she was pretty solid on was the actual lobbying aspect. But yeah, I think only thing I would have changed if I was kind of peer reviewing this for CNBC is saying put the vocab terms closer to the beginning so that the audience can kind of gauge what they are. You can't assume that everyone just watching the video from the beginning knows the difference between avoidance and evasion, and try not to confuse the audience by kind of combining the two without a proper transition. So without saying this is avoidance, this is evasion. Again, that would help if it was more in the beginning, so that you don't, again, confuse people, because not many people will actually watch up to that point. If you actually look at YouTube analytics on average, most people kind of just watch the beginning. The outrage is more focused in the beginning part, and then towards the end was actually the base of the real value, I think, of this video. So yeah, but much better than the last video, way better. And I think the other video is fresher, and then this video is older, unfortunately. So it seems like you've gotten a little bit worse. Go back to this type of coverage. This one was good. All right, on that note, guys, thank you guys so much for watching, and I'll see you guys in the next one. Bye.